Welcome everyone to the session. My name is Paul and I look after behavioral finance for Momentum Investments. Thank you very, very much for having me today. A good place to start, I guess, is what is behavioral finance all about? And what you can see on your screens now is quite a neat summary. So what you can see is a series of images from the very famous Stanford marshmallow experiments conducted in the 1960s by Walter Mischel. And what you can see is a series of images which neatly explain, this sort of constant tension that we have when we make financial decisions between what is right and what is comfortable. So in the top left there, this kid knows that, if he holds it up for 10 minutes, one marshmallow is going to become two marshmallows, right? But in the bottom right-hand corner, of course, what is comfortable is taking that marshmallow and shoving it in your face almost immediately because it, looks so good, tastes so good, smells so good, for example. And this is the constant tension that is in financial decisions that we make. We know what the right answer is, but we find it very, very difficult to actually do that. Machines find making these decisions quite easy. Human beings find making these decisions quite difficult. And really, behavioral finance does exactly that. It bridges the economic and finance theory, so the right answer with the comfortable answer, which is rooted in psychology, right? And these are things helping us to explain why we find it so tough to make these decisions. We turn to disciplines like sociology and psychology, for example, to help us explain what the difference is. Now, the reason, again, I've mentioned psychology a few times here. This is quite interesting because the world is kind of moving towards what many people are calling the empathy economy. And the empathy economy is a place where psychology is being turned to solve the world's problems and away from economics. So towards psychology and away from economics. Now we're at an interesting place because we're looking at things like GPT-4 and AI. But at the same time, we're also trialing a 4-day work week, right? So the empathy economy is a place where, if we look back at the Industrial Revolution, an image you can see on your screens now, the Industrial Revolution left behind some scars. And one of these scars is time poverty. So people are starting to think these days, well, is it important having a fancy job title and a big paycheck if I don't have enough time to spend and have life experiences with my friends and family? So we're thinking about concepts of a lifestyle dividend, for example, right? So take a lower paycheck, but spend more time with the people that matter. We're thinking of things like a memory dividend, for example, right? So not just about stock dividends anymore, but memory dividends. So the earlier that I am, it's not just about 65 and waiting and, your whole life working and then retiring. It's about gathering experiences all along the way, because the more often you recall these experiences, the more memory dividends you get, and that's worth something as well. So, Bill Gates has a very, very interesting take on this. His take on this basically is that, should we be protecting the jobs from machines when a lot of these jobs are actually making people miserable? So Amazon, for example, a couple of years ago made headlines because of their policy on monitoring the amount of time their employees were taking in bathroom breaks, their warehouse staff, right? So should we be worried or protecting those jobs from machines and AI? Probably not. Let AI and machines take the process-driven jobs away, and then Bill Gates says charge a robot tax, for example, and use that to actually create a universal basic income grant where we can then reskill those people to enter the empathy economy, to look at things like financial planning. Look at the humanities, right? Look at psychologists, look at therapists, look at family counseling, look at all these kind of things where we, which is really what human beings need. I mean, a good friend of mine went to the dietitian the other day, and the first consultation him and his wife had with the dietitian had nothing to do with calories, nothing to do with blood tests, nothing to do with chocolate bars. It was all about psychology. So it's all about when do you eat, why do you eat? So what is your relationship with food, for example? And this is what we're starting to understand more and more as well. In many cases, we know what the right decision is. We have all the information. Knowledge is not the problem. The problem is that the understanding is that in order to get real behavioral change, we need to turn to disciplines and concepts in psychology, for example, to help us make the right decision instead of making the decision that's comfortable, which obviously is, impulse spending now on credit, for example. And this sort of leads into what we're talking about today, which is financial well-being. And financial well-being, mental well-being, of course, is a very, very important part of financial well-being, simply because those two things are linked, right? Money is an extremely emotive topic. money can be an extremely big source of conflict in a relationship as well. Where one party is focused on saving, the other one is focused on enjoying life now, right? Those are two different value systems. So if you're going to have different value systems in a relationship, for example, it can cause conflict. Money can cause very, very emotive feelings like guilt and shame, for example. Our childhood experiences, for example, have a lot to do with how we deal and make money decisions as we grow up as well. So in terms of financial well-being, the last part of the session, I'm going to talk about sort of the right decision. So what is the structure, the good sort of structure to being financially well? And then I'm going to have a look at a little bit of the psychology behind it as well. And we've actually developed a money fingerprint assessment that I've actually built with the University of Pretoria, the psychology and financial management departments, where we're giving financial planners and MFP the ability now to start diagnosing or having these personality theory discussions or personality sort of diagnosis tools that they can help their clients understand themselves and understand where their factory settings are good and not so good, right? And then sort of develop techniques to help them make better financial decisions. So if you look at the images on your screen now, we'll start with the one on the right. That really is the structure decision, right? So what is the right decision? What does the structure of being financially well look like? If we look at it in very basic terms, we can look at those concentric circles, and we'll start on the outside going towards the middle. So the first thing we need to do if we want to be financially well is we need to create space for saving, right? And that means we need to take a good hard look at our budget. So a rule of thumb to use here is the 50-20-30 rule. So no more than 50% of your after-tax income should be on your big ticket items. That's your house and your car, for example, right? The middle block or the middle piece there is savings. That's no less than 20% of your after-tax income should be spent on savings. Savings is deliberately in the middle. We'll come back to that now. And 30%, no more than 30% should be on your discretionary spending stuff, right? So that's your gym contract, your cell phone contract, you're going to eat out, saving, holidays, all that kind of stuff. So the important part of the savings being in the middle is that if you're spending more on the big ticket items, so if that 50 number is bigger, it shouldn't come out of your savings, it should come out of your discretionary spend at the end, right? So very, very important that you have that 20% in the middle. That 20% then starts creating a little bit of room for you to then move to the next block, which is looking at your risk, just making sure that your risk management is in place, right? You've got a good medical scheme. You have enough insurance. If something happens to your partner or spouse, can you, especially if you've got kids, can they maintain their standard of living, for example? So do you have enough life cover? Do you have enough cover, short-term insurance cover as well if you're involved in an accident? Things like dread disease, for example. Just understanding exactly what that picture looks like, and that you are, risk is adequately managed. Some risk you're going to accept, other risk you're going to transfer over to an insurer. Once that's taken care of, you can then start to look at the savings and investing piece of your financial well-being. The savings piece. So we look at the block. There's a little pyramid in the center of your screen. So on the right, that means that at the bottom you start with an emergency fund, right? So that's the savings piece. Make sure that there's enough emergency savings that if you get involved in, or there's a sudden repair that needs to happen on your car, there's a medical procedure that needs to be done, you're not dipping into your long-term savings, which is a market-linked, equities or shares, which are risky assets, that you're not having to sell those to do repairs on your car, because of course it might be in March 2020 when markets crashed. You might have to sell at a period where markets are down, right? Which means that you lose money. And that's the important part. Selling means you realize that loss. And, whereas the correct decision in that case is to wait for markets to recover, which of course they eventually will. So bottom of the pyramid there, emergency savings, that's very important. Once that's in place, you then move on to education. So make sure that your kids, there's enough money set aside, for example, for your kids to go to the high school and the university that you would like them to go to. Once that's, again, now you're moving up the pyramid. Once that's in place, retirement. Make sure that you have, you have enough money to retire on. Generally, about 75% is the sort of the mark that people look at. So take your current after-tax income, for example. You can take that reduce that to 75% of what it is now. And that's a good aiming point, for example, in your retirement that you'd probably need. Once that's taken care of, then it's time to create wealth. And this is the big problem. A lot of people, what they do is they start at the top of the pyramid. They start investing in these things like crypto and private equity funds and hedge funds and equities and stocks, and without having the other building blocks in place. And what happens is, again, you might be in a situation where you're forced to sell one of those investments because of something else that happens in your life, which of course is the wrong way to do things. So make sure that the building blocks, you carry on putting them in place, and eventually at the top you get to creating wealth, and in which case you can think about all these great and wonderful, exciting things, especially if you've got a longer time horizon to invest in and create some real wealth. Now, that's the general correct structure to sort of financial well-being. But now let's have a look at some of the things that get in the way of this, right? And these are really our factory settings. So this is the psychology of money behind this. So I'm going to focus today on 2 personality traits which have been shown to transfer very well across domains. And what I mean by that is, they are applicable to the world of investing. They're applicable to a lot of different domains in life, right? To risk taking in general. They actually transfer across these domains pretty well, which basically means that they apply in these different settings in the same way. Now, the 2 that I'm going to be talking about today are conscientiousness. And conscientiousness is very important because that is the personality trait that those kids in the Stanford marshmallow experiments, the ones who managed to wait until the end, they had conscientiousness in spades, right? So they had a lot of very, very high levels of conscientiousness. They were able to focus on the future, right? And not focus on the present. So focus on the next marshmallow that was coming in 10 minutes time. Now, by the way, a nice life hack here as well is that if you think about people who are good at thinking about the future, just think about yourself. When you park, next time you do your monthly grocery shopping, or the last time you did your monthly grocery shopping, did you go in nose first with your car, right? So that's easier now, but more difficult when you leave. Or did you go in bum first? Did you alley dock, right? Which is more difficult now, but easier when you leave. So that will also give you an indication just of people who thinking about the future, right? Or naturally, their factory settings. And by the way, your personality, half of it, about 50% of it, comes down through your genetic code, can be directly mapped to areas of your of the human genome. So these things are transferred down our genetic code. If you have conscientiousness as a personality trait, just like those kids did with the Stanford marshmallow experiment, I've got some good news for you. There's a lot of research to show that you're going to be earning more money, you're going to have better relationships, because you're constantly thinking about the future. So conscientiousness is an extremely good trait for saving, because of that reason that we tend to be future oriented. Neuroticism is the anxiety piece, right? So people who are neurotic by nature tend to activate the fight or flight a little bit more often. It's not just negative. So neuroticism sounds like a very negative thing, but people who have a slightly higher level of neuroticism are also quite nurturing. They don't just worry about themselves, they also tend to worry about other people as well. But biologically, activating or having neuroticism as a personality trait means you're activating fight or flight a little bit more, which means that you have cortisol flowing through your bloodstream a little bit more as well. Research has shown, the Wharton Business School have showed that having cortisol in your bloodstream basically blocks access to your prefrontal cortex, which is your center for logical thinking, and basically you will rely on gut instinct. So think about a market crash, for example. What's going to happen is access is blocked to your prefrontal cortex. You don't think logically and you act emotionally, right? So you act spontaneously, impulsively, for example, right? So think about the interplay of those 2 things now. If you have low conscientiousness, for example, right, and you have high levels of neuroticism, for example, that is the danger zone in the bottom left corner of the screen, right? So you're thinking about now and you're impulsive. So if we saw during the COVID pandemic, for example, about 650 million rand was destroyed on the Momentum Wealth platform from people moving out of equity or risky investments during the market crash, and then trying to buy back in actually after markets had fully recovered. In actual fact, buying back in at levels which have actually surpassed the level where markets had actually completely passed the previous highs before the crash happened. So this is the important thing here, right? There are 2 very, very important personality traits when it comes to saving and investing. The one is conscientiousness. You want high levels of conscientiousness to think about the future. And ideally, you'd like lower levels of neuroticism as well, which means that you're less impulsive and you're less anxious and worried about what's happening in the present. If you've got higher levels of conscientiousness and lower levels of neuroticism, you've got good factory settings for saving. Now, the good news is just because you've got good, or the good news and the bad news rather is, maybe ultimately the good news is, just because you've got good factory settings doesn't mean you're always going to make the right decision. But it's definitely very, very important from an awareness perspective to, when you don't have good factory settings for investments, in other words, when you're in that danger zone, to have someone like a financial advisor, particularly to help you, because there are techniques in financial therapy, for example, called stress inoculation, where you plan for bad things to happen. And this is a very, very important thing, and maybe one of the last things to finish off on. Human beings hate uncertainty. In actual fact, recent experiments showed that we have more stress chemicals, cortisol, flowing through our bloodstreams when we have a 50% chance of electric shock than when we have a 100% chance of electric shock, right? We hate uncertainty. There are techniques in financial therapy and financial counseling, financial psychology, that called stress inoculation, where we plan for things to happen like market crashes. We write down what we're going to do the next time the market crashes, because it will. And that active planning helps to inoculate us against the stress. And make those incorrect decisions when inevitably markets actually crash or there is market turbulence, for example. So I hope you've enjoyed this very brief chat today. I mean, this really gives a good interplay of, we need to understand that there's a very, very set process to becoming financially well, and a formula that we can follow, but then also we need to understand ourselves from a psychology point of view to make sure that we continue to make the right decisions along the way, because often those decisions can actually completely derail all the good plans and the good work that we've put in play building up to being financially well. So please do reach out to me if you'd like to know more about the money fingerprint we've developed. And I really, really hope that you have a great financial advisor with you along this process, or along this journey of becoming financially well. And please do feel free to reach out to me if you have any other questions or some more other things you'd like to chat about. Thank you very much for your time. Thank you.